For those who have joined already, just a little bit of housekeeping before we start. If you wouldn't mind keeping your cameras off today and stay on mute throughout. Don't worry, if you accidentally go off mute, we will quickly fix that and set you off mute. If you have any questions at all, please feel free to put these into the chat box and we will get to them if we can, either throughout the presentation or at the end. So let's get into it then. Welcome to everybody today. For those who don't know me, my name is Caroline Stevenson and I am a partner and head up the financial regulation team here at Burnes Paull. Today I'm joined by two amazing colleagues. I'm going to let them introduce themselves now before we get into it.
So I'm Marianne. I'm a senior solicitor in Caroline's team.
And I'm Jake, and I'm a solicitor in the financial services team with Caroline and Marianne.
And it's safe to say that the three of us love the retail banking sector. Anyway, so the majority of what we're going to talk about today is developments on the items which were identified by the FCA in its strategy for retail banks in 2025. And that was published late last year, and it's a really good barometer of the types of things that you and your change team should be focusing on, or your compliance team indeed, and should be focusing on over the next year to make sure that you are compliant. However, that said, it would be remiss of me not to comment on what a crazy year this has been so far in relation to the retail banking world. I'm sure you've noticed, but every single day there is something new to understand. A few examples are just this week, the FCA's quarterly consultation has been published. That's got a few interesting nuggets in it. We've also recently had a huge systemic IT outage, which has caused a bit of mayhem, but did cause huge amounts of disruption. And I think anybody who had recently implemented their DORA changes were quickly pulling out their contracts to check what was in there. In addition to that, I think the whole industry is waiting with bated breath to understand the position on commission disclosures. AI and crypto has absolutely exploded. On top of that, sustainability and general ESG is on the lips of every board. We finally have a published roadmap by the Bank of England setting out steps to deliver the UK's digital pound, which is really exciting. And the regulators are continually getting a bit of a hard time from the government. And also around kind of a similar tone, deregulation is being constantly mentioned, yet every single day there seems to be another regulatory development. And only yesterday, the government abolished the payment systems regulator. Phew! Anyway, we'll get into emerging risks later, but I think that it's safe to say the regulator really should highlight the fast pace of change as a key risk this year in 2025. And so I really do sympathise with each and every one of you. On top of all the BAU, it must be so hard for you to keep on top of the regulatory developments in the sector at the moment. So hopefully the next hour will be really helpful in bringing to light some of the key areas that you should be focusing on your time on. Elaine, if you want to pop to the next slide, you'll see our agenda today. So today we're going to be talking about consumer duty, borrowers in financial difficulty. We're going to talk about access to financial services, op resilience, vulnerable customers, and the topic that is hot on the lips of everybody and lots of CMCs, the motor finance and commission claims, which is ongoing and changes every day. So on to the next slide, we will commence with consumer duty. And it's safe to say that consumer duty really is the gift that keeps on giving. And it's true, the FCA have stuck to their word that they said all along is it's not a one and done exercise. That said, I think a significant, if controversial development in consumer duty occurred a week or two ago when the FCA confirmed that a consumer duty champion at board level is no longer required. There's lots of chatter I mentioned about deregulation, and this could be part of that, but I suspect the FCA's view at this stage is that consumer duty should already be deeply embedded into governance and culture, so a standalone champion role is no longer required at board level. Beyond that, there's been quite a few publications over the last year around their expectations in relation to the duty. They've set out some examples of good and poor practices. And of course, the first board reports were published and commented upon. So in terms of consumer duty, what should your firm's priorities be over 2025? Well, the next slide should show this. Thanks, Elaine. So firstly, I think the FCA is very much expecting that firms continue to embed the duty into your culture and your full range of retail banking and mortgage activities. They keep parroting on about this, but they really do want to change the culture of firms to make sure that customers really are at the centre, and that they're getting a good service and good products and services that meet their needs. And the FCA is also looking for firms to improve use of MI and dashboards to continue to monitor and evidence good customer outcomes under the duty, and also to identify and address poor outcomes promptly. I think the FCA this year will be asking for the detail behind the summaries within your board report. So I'm very much looking at your workings as well as your outputs. In relation to transparency, the FCA will expect you to be open and honest about outstanding challenges or issues arising from your implementation of the duty, particularly in relation to closed products and services. And I think this transparency is particularly important where your firms really struggle to maybe interact with customers due to poor engagement because it's an older book, or because there's a high number of gonaways, for example, or also where you have very poor records in relation to the cohort of customers that you're concerned with. For example, where you've purchased a book through a Part 7 transfer, you might not have all the detail in order to do some full analysis. And they're looking for you to be really transparent about that in order to ensure that you are on top of things. Finally, the FCA has really picked out mortgages as a particular area of focus in relation to the consumer duty, and have found that the certain firms have really struggled with consumer duty compliance in mortgages. Against that backdrop, the FCA has really reiterated that they really expect firms to continue to lend responsibly, which is a given, but also they really want you to conduct thorough affordability assessments. And we're seeing some really interesting fintechs come through the market in relation to how you can do this more easily or more efficiently. The FCA have also got a key focus on later life lending and second charge mortgage lending, where I think they feel that there's a higher risk of those types of firms those types of products not providing good customer outcomes. So that's one to watch and sort of look at closely. If we pop on to the next slide, this sets out what we think we can expect then over the next year. I think the FCA will definitely continue to monitor the sector in detail to try and identify where poor retail customer outcomes are. I think they'll probably do this through a closer lens on complaints trends, and also given the motor finance cases, I think they'll have a close look in litigation as well. Given their higher pool of customers, I think those of you who work in some of the larger retail banks are likely to get more direct engagement with the FCA, asking for more details on your control frameworks, your monitoring, your MI, just really what you're doing to continue to embed the duty within your organisation. And I think finally, the FCA has declared that it will be monitoring the savings market quite closely to satisfy itself that it's operating fairly. And I think in relation to savings, the FCA will be looking at the differences in interest rates between front and back books. They'll also be looking at how your firm implements changes to base rate, how quickly that can filter through to end customers. And they will be looking at how engaged your customers are, where you're communicating sort of maybe better offers, or sort of signposting that there might be a better suited product to them. So I think that's definitely in relation to savings what you can expect this year. So I think under the lens of consumer duty, I think it's really clear we can probably expect quite a few deeper dives from the FCA over the coming months. And yeah, keep an eye on your savings and mortgage products in particular to make sure that they are compliant and providing good customer outcomes. Anyway, that's all on consumer duty today. Marianne, do you want to pick up the next topic?
Yeah, sure. So thanks, Caroline. So moving on, but very much continuing the theme of ensuring good outcomes for consumers, one of the FCA's focuses for 2025 is on the treatment of borrowers in financial difficulty. So the FCA's Dear CEO letter made clear that firms should be continuing to meet the standards expected of them when dealing with and supporting borrowers who may be struggling. So if we move on to the next slide. I'm sure you'll know that the FCA's work on borrowers in financial difficulty has been ongoing now for some time. It began largely due to the need to help consumers manage the financial effect of the pandemic. And the Tailor Support Guidance was introduced in 2021 as a framework for lenders to offer support to their borrowers during that time. There are, however, now new rules in place in relation to mortgage, consumer credit and overdraft products. And these new rules build on the tailored support guidance. They deal with the forbearance measures which should be offered to borrowers who may encounter financial difficulties while using these product types. And these rules were introduced following the FCA's policy statement, PS 24.2. The new rules came into effect on the 4th of November last year, and they've been incorporated into the handbook by way of updates to CONC and MCOB. And the TSG have therefore now been withdrawn. So I won't go into detail about what the new rules are, as I'm sure they'll be familiar to many of you who work or advise on mortgage or credit products. And I'm sure they'll be very much embedded into your policies and procedures by now. However, I will set out some high-level themes which came out of the new rules. So these are set out on the next slide. So the first is that the rules are wider than actual payment difficulties. So MCOB and CONC have been amended so that the forbearance rules capture customers in potential financial difficulty at an earlier stage. The existing rules have therefore been widened in scope to cover customers who are approaching arrears or who are at risk of falling into a payment shortfall, and not just those who are already in arrears or have defaulted on their loans. The next one is tailoring of approach. So there's a much greater focus on taking account of individual customer circumstances when implementing forbearance measures, including tailoring communications in order to reflect the needs of individual customers. The next is in relation to the range of appropriate forbearance options. So under the new rules, firms are required to provide their customers with an enhanced range of forbearance options. And the FCA has amended CONC and MCOB to expand its existing list of potential forbearance options which lenders might want to offer their borrowers. The list of options contained in the handbook isn't intended to be exhaustive. It should very much be considered or used on a case-by-case basis. And then finally on that slide, in relation to reviewing forbearance measures, so for credit products in particular, CONC has been updated to state that firms should review the forbearance they offer to customers at appropriate intervals to ensure they remain suitable. And the FCA also expects firms to review compliance with their forbearance policies and procedures at regular intervals. So moving on to the next slide, just in terms of next steps. The FCA made clear in its letter that it intends to continue to monitor data on early arrears and payment shortfalls in relation to mortgages, overdrafts and credit products in order to highlight trends, issues and outlier firms so that it knows where to focus its engagement or make interventions. And the FCA says that it's likely to focus on segments of the market where customers may be more likely to have characteristics of vulnerability. It will remain alert to signs of poor treatment or outcomes, including where firms are not offering suitable forbearance options or not exercising these appropriately. In its letter, the FCA kindly reminds firms it recently fined a firm for failing to ensure customers who were in arrears were treated fairly. So this reference is in relation to the enforcement action which was taken against TSB in October of last year, where TSB was fined almost £11 million for its handling of retail customers who were in arrears or suffering from financial difficulties. Not only was TSB fined, but it was required to carry out a significant remediation and redress exercise, which cost it over £99 million in total. TSB is certainly not alone. There are other examples of enforcement action being taken against banks and firms for similar reasons, such as the £6.2 million fine issued to HSBC last year for historic inadequate treatment of customers in financial difficulty. And this led it having to pay £185 million in redress to 1.5 million customers. So it's really helpful to look at the FCA's enforcement notices in these cases in order to get an idea of factors the regulator will consider when deciding whether customers have been treated fairly or not. There's clearly significant sums involved when, in the regulator's eyes, firms don't get things right. So it should definitely be an area of focus for firms who are dealing with these product types. So moving on, I'm going to pass you over to Jake, who's going to look at access to financial products and services.
Thanks, Marianne. So, access was the third priority that was listed in the Dear CEO letter, and it's particularly a focus on continued access. So, in a lot of ways, it kind of reflects the FCA's focus on continuing the consumer duty and also in sort of looking out for vulnerable customers. So if you can go on to the next slide, I'll go into what the letter was really focused on. So as I mentioned, it was a real focus on the FCA's expectations for retail banks in the kind of area of access. And a lot of this focus was on continuing and preserving access rather than expanding it, for instance. So there's been quite a lot of recognition that many banks are closing their branches and they're becoming solely accessible through digital means. So on that basis, the FCA's reminded banks that who are taking this approach to take care to ensure that retail customers who may be digitally excluded or in vulnerable circumstances are not experiencing foreseeable harm or poor outcomes as a result of this move towards digitization. And part of this, they pointed towards their 2022 guidance on branch and ATM closures. And under this, firms are advised to focus on the provision of suitable alternatives to digitization, as well as continuing to help customers to move to digital so that they're not excluded as a result of this. There was also attention drawn towards the 2023 review of payment account access and closures. And as part of this, they reminded firms that under the payment account regulations, they mustn't decline, suspend, or terminate payment accounts based on a range of characteristics, including political views, and also that where a resident meets the required eligibility criteria, designated credit institutions are required to offer basic bank accounts to that consumer. So it's really very much at this point in time a kind of reminder of what the banks are expected to do by the FCA. And then there's a section that covering what the FCA is actually going to do to support this priority of access. And the action list is still similarly focused on the continuity of access as they reaffirm their commitment to engaging with banks on programs of transformation and digitization. So this is again is trying to ensure that banks are continuing to go through this process towards digitization in a way that's fair and takes regards to customers in vulnerable circumstances. And the kind of other action that they listed within this is that they're going to continue to monitor customer contacts on suspended accounts. So where they're finding that firms have outlier rates of suspension, that they're engaging with those banks to make sure that improvements are being made and that the relevant systems and controls are in place where appropriate. So the really consumers who shouldn't have their accounts suspended or payments declined aren't being this isn't happening unfairly or incorrectly. So if we can move on to the next slide, I'll take a look at some of the action that they've taken this year. So this really is kind of indicative of what was set out in the Dear CEO letter, as they're setting out their expectations and a reminder to banks rather than taking an active step towards anything. So what they're doing here is they're reminding banks that there's flexibility in their rules for determining affordability of mortgages, because the FCA is acknowledging that within MCOB 11.618R, it requires lenders to take account of likely future interest rate increases when on affordability for a minimum of 5 years when they're assessing affordability for a consumer applying for a mortgage. And it reminds banks that there's, as assessments for stress testing can be adapted for different market conditions, the FCA still expects the stress test to be compatible with, but not linked to market expectations. So because of this, they reiterated the rule doesn't prescribe which rates a lender should consider when designing the stress test. So it could be an initial rate, it could be the firm's reversion rate, or it could be a follow-on rate. And what they've found is that a lot of firms are using a stress test of affordability by adding a margin to their current reversion rate. But where a lender's reversion rate doesn't consider a market expectations, it can cause for an unnecessarily high stress test, which then can be restrictively high for some consumers who would be getting what otherwise is an affordable mortgage. And because of what this has become a slightly common practice, and this common practice may be preventative to many consumers, the FCA sought to highlight that there are other approaches that firms can take but still meet the requirements for stress testing. One example that they gave is where the interest rates rise within the first 5 years of a mortgage. And if a customer is expected to revert to a reversion rate during that period, the future rate should be taking account for the affordability of that mortgage. So this would apply in circumstances where a lender doesn't offer product transfers and the customer is at this point on an initial rate. That customer will move to a reversion rate at the end of the deal, and the expected future rate with the lender is what then should be used to consider the stress test. And then in addition to this, they did highlight that there is an ongoing review of the mortgage rules. And as part of this, the stress testing requirement of 11.618R is being evaluated with this. And there's a plan for there to be a call for evidence to look at the impact of this rule. So there is somewhere to watch that they're going to be looking at potentially changing it in order to kind of really emphasize the flexibility that's available to banks so that they are able to make sure that there's not this restrictive barrier to consumers getting what otherwise would be an affordable mortgage. And if we can move on to the next slide, please, Lane. And this again follows on from the FCA's highlighting the flexibility of interest rates, but it's taking a slightly more active step in addition to reminding what the existing rules are. So as part of this, they've announced that in May that they're intending to consult on simplifying changes to the rules on mortgages. And this is with a view to improve access, but this is to more situations where a customer may be seeking to remortgage with a new lender, and then discuss options outside the regulated advice process, but also reduce their mortgage term. And then there's a kind of very strong continuation with this is then just a month later, the intention for the FCA is then to open a public discussion, and they're going to be looking at the future of the mortgage market and the FCA's role in it. And they're looking to bring discussion on a few aspects of it, such as banks' risk appetite, their risk taking, and affordability testing. So there's a real view to, I think, understanding where banks are in terms of what the access options are being given to mortgages at the various stages of life of a mortgage product. So it's not just the actual access to the initial mortgage, but it's the access to differences in the product throughout the whole life of it, as obviously these are long-term products for the majority of consumers. So with that, I'm going to wrap up the access side of this, and I'm going to hand over to Caroline, who's going to look at operational resilience.
Thanks, Jake. So operational resilience was the next item on the FCA's hit list back in September when they set out their priorities. If we go on to the next slide, Elaine, I'm just going to bring you back to a reminder. We're fast coming up to a deadline, but 31st of March 2022, so 3 years ago, saw the introduction of the new operational resilience regime in the UK. And the objective of that new regime sought to improve the operational resilience of firms and the general financial market infrastructures, ultimately to protect consumers and the broader financial sector, and also the sort of the UK economy from the impact of operational disruptions. Through the introduction of those rules, firms, I'm sure you're hugely aware, were required to plan and deliver improvements to operational resilience so they can respond effectively when disruption does occur. And under that regime, a couple of new concepts were introduced. The first being important business services, where firms were required to identify services of such importance that clients or the financial system as a whole could be disruptive if there was an issue with them. And the second new concept at that time was impact tolerances. So once the important business service was identified, firms would then have to set an impact tolerance for disruption to each of those services. And through that, this was to ensure that firms could continue to deliver those services and remain within their impact tolerances during severe but plausible scenarios. So as you'll be acutely aware, again, given the size of this task, because it was massive, you've had to look at everything. Firms were provided with that transitional period of 3 years, but that expires on the 31st of March this year. So by that point, firms will have had to know what their important business services are and really have an understanding of how much tolerance they can suffer before they cause disruption. So that's kind of the backdrop. We're just getting to a critical point in that. But in relation to operational resilience, regulators do not like to sit still, because you might have noticed in December last year, the FCA published further consultation paper that is seeking responses, and which actually closed today, 13th of March. And this consultation paper is looking into further items of operational incidents and third-party reporting. And so we will expect to see more requirements around this to land in the second half of this year. So watch the space for that. Well, why is this? Well, the FCA is closely monitoring a number of emerging risks. And if we pop on to the next slide, you'll be able to see some of these. The first one is concentration risk, which has become a real risk in financial services to whole, not just retail banking. And that's because so many banks rely on the same provider of their underlying banking platform. And when that goes down, it can cause systemic disruption. Only recently, you might have noticed, if we would have all laughed if it had been 1st of April, but 1st of March, Microsoft went down, and that caused significant disruption and panic amongst the sector. And I think that type of scenario has really justified the FCA's focus on this. The FCA also feel generally that supply chains aren't really protected as well as they could be. And third-party failures are often cited as the root cause of incidents. But as you know, with the FCA, that argument does not wash with the regulator, because despite outsourcing, your firm as a regulated entity is still on the hook to ensure regulatory compliance throughout your supply chain. And ultimately, through that supply chain and the controls you put in place, you're required to try to maintain continuity of supply to your customers. And so I think this year, and we've seen it come through from a European level through the implementation of DORA, I think there will be a greater focus by the FCA in ensuring that retail banks, supply chains, contracts, and underlying processes are really watertight to try and make sure that everything has been planned and that there are protections in place to avoid disruption in the future. Goes without saying that cyber is a huge emerging risk in the sector. Cyber criminals are becoming ever more sophisticated. And so firms are really expected by the FCA to really plan and test for these scenarios and to ensure that they are as protected as possible. And there's new technique, which is quite interesting if you haven't read about it. It's called living off the land. And this is a new technique that sort of cyber criminals are using, where they infiltrate a firm's own environment to carry out an attack. And this makes it much harder for firms to detect and deal with. So it's ever more important that firms really have specialists in place to help them navigate this ever-changing and evolving landscape of criminal activity. And finally, one other thing to highlight is malicious insiders. This is another emerging issue that the FCA has noted, and that firms, in order to safeguard this, really need to ensure that their employee onboarding and continuing monitoring of employees is really robust to ensure that any sort of bad actors can, as far as possibly, be sort of could be monitored and sort of safeguarded. You can safeguard your firm against them. And I think those 6 risks that we have on the screen are just 6 items of what should be a huge, massive, comprehensive list of threats within your own crisis management paths and plans. I think given that there is so much to think about and it's such a evolving framework, I think it's really clear that op resilience is a focus for the regulator. And so because of that, what do you think we can expect this year? If we pop on to the next slide. I think there will definitely be further engagement between firms and the FCA. I think especially where you are embarking on sort of major technology change programs, I think the FCA will want to come on that journey with you to make sure that you're doing this efficiently and also safely, that ultimately trying to restore and maintain continuity of service to customers. I think European initiatives like DORA, which is the Digital Operational Resilience Act, which I think those types of initiative will continue to filter through to UK firms, and which will ultimately require lots of contract remediation to make sure that your contracts are watertight and also in compliance with the latest regulatory requirements. And I think that the hotly anticipated and ever more important, given the recent outages, the critical third parties regime will be expedited over the course of this year. So just finally, as a reminder, the new critical third-party regulatory framework provides HM Treasury with an ability to designate IT providers as critical third parties, which will therefore bring those firms who are generally at the moment unregulated entities into the regulatory perimeter. We're not aware of the full details of who will be deemed to be a critical third party at this stage, but it's likely to be those firms where service disruptions could threaten UK financial stability. This could be due to the materiality of the services that they provide to a particular firm, or it could be due to the concentration of that IT supplier's service in the industry. Once designated as such, critical third parties will have a sort of dotted line into the UK regulators, and so they will require to comply with fundamental rules, which you'll all be familiar with because they're quite similar to the FCA's principle for business. For example, it will require them to conduct their business with integrity, which is interesting in an IT sense. And there will be also some other specific rules and guidance. So I think that this, once it's embedded in the UK, will really be it will really change the focus, because at the moment, as a regulated entity, it's you that are sort of solely responsible to the FCA for ensuring the sort of compliance and integrity of your supply chain, whereas this takes the pressure slightly off firms, given that some of those key firms will then have a dotted line into the regulators themselves. So a little less pressure, but I don't think there will be an easing of the regulatory burden for you all. But let's watch this space. I'm going to pass back to Marianne now for the next segment.
Thanks, Caroline. So that covers the topics that we wanted to look at within the FCA's Dear CEO letter to retail banks. However, there are some other more recent developments which we wanted to touch on, which are still very much relevant to the retail banking sector. So if we move on to the next slide, I'm going to talk about vulnerable customers, which is, as you'll know, a huge focus for the FCA, and the treatment of vulnerable customers. It isn't listed as a standalone area of focus for 2025. However, it is relevant to all of the focus areas which we've already discussed. So whether that be in embedding of the consumer duty, fair treatment of borrowers, or ensuring access to financial services and products. It's also very topical at the moment because, as you may have seen, only last week on Friday, the FCA published its findings from its review of firms' treatment of vulnerable customers, which it carried out in 2024. The review focused on evaluating firms' treatment of vulnerable customers and consumer outcomes, including looking at how firms are supporting customers in line with the FCA's 2021 Vulnerable Customer Guidance, and considering whether the guidance remains effective and appropriate in light of the consumer duty. So in order to carry out its review, the FCA gathered a very high volume of data from various stakeholders. This included interviews with experts, research into experiences of vulnerable customers themselves, analysis of its financial life survey, and it also conducted a survey of 725 firms in total. So one of the main headlines that came out of the review is the fact that the current guidance will remain in force and unchanged. The FCA will not be revising the guidance at the moment or introducing new requirements for firms. The conclusion reached was that the guidance remains appropriate and helpful alongside the duty, so I'm sure this will be good news for many firms. The other good news story is that the FCA found many examples of positive actions by firms across sectors. So some examples of good outcomes are set out on the next slide. If we can move forward, please. And these include the following. So a small number of firms were found to be using data effectively to identify where vulnerable customers were experiencing worse outcomes than others. Some firms were successful at delivering flexible and tailored supports, strengthened by adequate training of frontline staff. Some firms have taken steps to review and improve the clarity of their messages to customers, tailor communications, and provide these in a timely manner to make sure customers understand product information. And there were examples of firms incorporating feedback from vulnerable customers' experiences in their product and service development process. There were, however, of course, areas for improvement. These are set out on the next slide, if we could move forward. So the first is outcomes monitoring. So most firms were unable to effectively monitor outcomes for customers in vulnerable circumstances. This included a lack of clarity on what firms considered to be good and poor outcomes, poor quality or insufficient data, and unclear approaches regarding actions to take in response to poor outcomes. The next is in relation to identification and disclosure. So the review found that some firms failed to identify vulnerability, encourage customers to disclose their needs, and then provide appropriate support. According to the FCA's consumer research, only 4 in 10 consumers with characteristics of vulnerability have disclosed their circumstances to any of their financial services providers, and only 19% felt that their provider encouraged them to do so. Identification of vulnerabilities was particularly challenging for firms that have primarily digital customer journeys. So the FCA therefore reminds firms to take active steps to encourage customers to share information about their circumstances or needs. Next is in relation to customer channels. So there were examples of firms not providing appropriate or accessible channels for vulnerable customers and a lack of testing of consumer understanding. Vulnerable customers were more likely to report that they'd failed to get the information they needed from firms, as well as be more likely to report a slower response to inquiries than other customers. And then finally, in relation to products and services, firms were often not able to show how they're designing products and services or reviewing existing products to make sure they meet the needs of vulnerable customers. Only 29% of firms said that they tested the impact a product or service has on customers with characteristics of vulnerability and whether the product meets the needs of such customers in their target market. Further, the FCA found that few firms are training product and service design staff on vulnerability, and training is often not covering how their role can affect customers in vulnerable circumstances. So overall, just to summarise, the general conclusion from the review is that there is good progress being made, but there's definitely more to do, particularly at the product design stage. The FCA is clearly keen for firms to get it right at the design stage and then carry this forward throughout the customer journey. Clearly, though, there's been huge progress made since the FCA's work on vulnerability began back in 2015, so 10 years ago now, and firms are obviously taking it seriously. Firms should, however, look at the examples of good and bad practice which were provided in the review findings and consider whether any improvements can be made to their own procedures. I'm not sure if anyone was on the webinar of the FCA on Tuesday, but they made the point that this is not the end of the road and that vulnerability is an evolving and dynamic area, which means it is very hard to get right, but firms do need to be on top of it and continue to adapt accordingly. So I'll pass you back over to Jake, who's going to cover the last section of this webinar.
Thanks, Marianne. So as many of you will be aware, this has obviously been quite a big story over the last, since January 2024, and is one of quite a keen interest to a lot of retail banks, given their kind of interest in the motor finance sector. So I'll move into the next slide and I'll give us a kind of brief rundown. So I'm sure for many of you, this is a pretty well-known story, so I'll try to keep this brief. In January 2024, the FCA announced that it would be conducting a review into the use of discretionary commission arrangements in the motor finance industry. In addition to this review, they also introduced an 8-week deadline for the an 8-week pause to the 8-week deadline for resolving complaints that related to DCAs. So then this investigation and also then the pause were extended in September 2024, and this extension was set to go on until May 2025. So then following this, there is a significant ruling made on 25th of October by the Court of Appeal in the Johnson, Hopcroft and Wrench case, where it was ruled that car dealers should have properly disclosed to customers that they were receiving commissions from the lenders who were providing the motor finance to the customers. So this obviously had a pretty direct relevance to the FCA's investigation. This court appeal then was, this Court of Appeal decision was actually then further appealed to the Supreme Court on the 11th of December 2024, and this case is now set to be heard in April of this year. So as we know, this isn't the kind of the end of the story. So on the next slide, I'll go into what's been happening most recently. So probably the biggest development in the motor finance space since the initial Court of Appeal decision was the FCA announcing just this Tuesday in a statement where they were covering their next steps on motor finance, that if it considered that there had been consumer harm and loss as a result of widespread failure from in the motor finance industry when it came to commissions, that it was going to be likely to consult on an industry redress scheme. This, of course, wouldn't be something we've seen to this scale since PPI. And it's still not a certainty that there is going to be a redress scheme, as the SA stated that it was going to take account of the Supreme Court's decision in the Johnson, Hopcraft and Wrench case in determining whether there had been widespread failure and whether this had caused consumer loss. And it also confirmed that they had been granted permission to intervene in the case, and also that it had filed a submission to the court for this. So it's really one to keep an eye on in April and then subsequently when the decision is handed down. There was also a change in the timescales from what there had been previously. As previously, the FCA was set to conclude its investigation and announce its findings in May. Now, the decision on whether a redress scheme is going to be proposed will be made within 6 weeks of the Supreme Court's decision. And if there is a redress scheme, how it's going to be implemented. And a final point that's slightly more for future consideration is that the Supreme Court's decision will also inform the FCA's thinking on how it will approach non-DCA complaints as well. So there's very much an evolving space, and I think it's a reflection of the view of Consumer Duty and trying to ensure good customer outcomes and not causing unforeseeable loss to customers. So if we move on to the next slide, there is still kind of an ongoing things happening in the background that are, this is probably slightly more good news to a lot of motor finance companies, as they've been receiving a large volume of complaints since the initial announcement from the FCA. And there's an expectation that perhaps a lot of these will go to the Financial Ombudsman Service. And given that every case that's referred to the FOS, the financial services firm must pay a £650 case fee regardless of this outcome, which is sure to be a sting for a lot of motor finance companies given the volume of cases that might be referred to the FOS. But in February this year, the FOS announced that from the 1st of April 2025, cases that are referred to them by professional representatives such as claims management companies, will now see that representative charged a fee of £250 to refer that case to the FOS. And it's not for every single case. Professional representatives are being given effectively 10 free cases a year where they don't need to pay any fee. But for all cases they refer after the initial 10, they will be required to pay that £250. And part of the thinking behind this appears to be with a difference in success rate between cases that are referred by professional representatives against those that are brought by the consumer for free. So in the statement, the FOS noted that 47% of the complaints it received between April and December 2024 were from professional representatives, but only 26 of these were found in favour of the consumer, compared to 38% of them being found in favour of the consumer when they were actually referred by the consumer. And then there is a sort of slight reprieve that's being given to professional reps on this in the referral fees, is where the decision is found in favour of the consumer. The representative will receive a credit of £175, so that will reduce their overall fee to £75. And a similar reprieve is given to the financial services fee firms as while the £650 fee stays in place, they're also given a reprieve where the complaint is not upheld or is withdrawn. The fee that the firm will pay is actually now reduced to £475. So now that professional representatives such as CMCs aren't effectively given a free hit to refer cases, it might see a decrease in the number of superfluous claims that are referred to the FOS that have no chance of success. And as a result, it means that firms will pay less in the way of case fees with that reduction in complaint volume, which I'm sure is a relief to anybody who's been suffering as a result of the increase in the number of FOS complaints in the past year. And if we move to the last stage, another point that's relevant to this motor finance is on another sort of significant case that was concerning undisclosed discretionary commissions that were paid by motor finance providers to brokers and car dealers. Unlike the Johnson Hopcraft Wrench case, it doesn't relate to the fiduciary duty owed by dealers and brokers or liabilities lenders. It's concerned with the ability for claimants to make use of the omnibus claim structure, where so this case arose when claims over 5,800 consumers who alleged that several motor finance companies made undisclosed discretionary commission payments to brokers and car dealers constituted an unfair relationship under the Consumer Credit Act. And the claims were issued through the raising of 8 omnibus claim forms in which the claimants were grouped by lender. And initially, in a county court decision, it was ruled that each claimant would need to be issued by a different claim form. But this was subsequently appealed to the High Court, and the High Court ruled in favour of these decisions on the basis that there is no requirement in the framework for omnibus claim forms that that claims of this sort must be identical, or decisions in lead cases be binding on all claimants. And as there are broad common issues in the claims, including whether the failure to disclose commission breached regulatory requirements and whether the lenders were liable for the broker's non-disclosure as agents, the court took the view that common issues such as these justified omnibus management of these cases. The opportunity for procedural efficiency also motivated the court's decision, citing that the omnibus route favoured access to justice for the claimants, which resolved the imbalance of powers that was existing between the individual claimants themselves and the defendant lenders. So the outcome of this is that it creates a structure now for consumers to bring claims in an omnibus structure, furthering their ability to successfully resolve their claims. And whilst this case doesn't directly influence the fiduciary duty issues on dealers and the potential liabilities of lenders that's being debated in the Johnson, Hopcraft and Wrench case, it does raise the possibility, depending on the Supreme Court ruling, that the door could be open for expansive remedies for consumers in respect of undisclosed commissions that could be now submitted through the omnibus claim structure rather than by cases being submitted on an individual basis. And with that, I think that comes to an end on the motor finance. And I'll hand you back to Caroline, who'll wrap it up for us.
Thanks, Jay. And I'm sure everybody will agree that what's going on in the motor finance world at the moment is sort of affecting all types of financial services. And we're seeing quite a lot of a different reaction. There's obviously everybody's sort of waiting in bated breath to see what happens, but also we're seeing some sort of preventionist or sort of risk mitigation actions taken in where some lenders are adding additional steps to their consumer credit journeys. It looks almost like a checklist of what all of the sort of the key items coming out of the Hopcraft, just to sort of mitigate future risk if the case goes in the favour of the borrowers rather than the lender. So it'll be really interesting to see. We do have 10 minutes left, and so we do have time for questions if anybody has got anything in particular they want to add into the chat. But we have one question so far from Brian, and the question is, will the FCA move to better define what constitutes a vulnerable customer? And he goes on to say that the range of characteristics that might apply is very broad. So I think there's definitely, unless Marianne's got anything to add on this one, I think the short answer to that one is no. I don't think the FCA will do it. I think more and more the FCA is moving to sort of just give outcomes based. They're giving sort of guidance and sort of outcome rather than giving explicit rules. So I don't expect us to get a better definition of vulnerable customers. And I think that's probably because it would be too difficult to define for them. I think vulnerability is really complex and it's transient. It evolves and it affects different people in different ways. In fact, it's really prevalent. I think the latest guidance and stats show that probably 50% of us on this webinar have got some type of characteristics of vulnerability within it. And so the FCA's definition, which is not the best definition, but their definition is that someone who, due to their personal circumstances, is especially susceptible to harm, particularly when a firm is not acting with appropriate levels of care. So it says a lot in that sentence, but it doesn't really say anything. So I think their 4 drivers of vulnerability is a better starting place, where they talk about health, life events, resilience, and capability being the main 4 drivers of vulnerability. And as you can see, that's hugely wide encompassing, but I do think it has to be that way to sort of try and capture everything that's included. Marianne, I don't know if you've got anything to add whilst I look at the next questions, because there's a few coming through.
No, I very much agree with what you said, Caroline. I think the FCA would definitely be reluctant to kind of provide a more definitive definition of what vulnerability is. I think firms are very much kind of expected to look at customer situations on a case by case basis.
Cool. So the next two questions are about motor finance. So the first one's from Colin, who says, is there any indication or view that the motor finance issue on undisclosed fees could cross over from consumer credit into the B2B lending market? And that's an absolute yes. Because it's about fiduciary duties and sort of the duties that brokers have and the conflict of interest, it absolutely could go into B2B. So I think that's why the whole industry is hotly anticipating and sort of waiting to see the outcome of this, because it's got far-reaching consequences if it's deemed that what was market practice was wrong. So I think definitely one to watch on both sides of the fence. Maureen has asked, between now and December deadline, do you know whether brokers or lenders are required to confirm the commission amount if asked by consumers, or instead can they rely on the December deadline to address all issues and queries? So I'm assuming in this one it's sort of the broker commission, which generally you would sort of acknowledge that a commission was paid, but generally market didn't confirm what it is. At the moment, the law is the same, the requirements are the same, that you're required just to do what you were always doing. However, that said, we are seeing some lenders add a step into their journey where they are specifically showing customers what they are receiving by way of commission and asking the customer to actively consent to that amount being paid by way of commission as part of that journey. So that's what I was alluding to earlier in terms of adding that additional step into your consumer credit journey. So there is a lot of risk mitigation ongoing. Whether or not that's the right thing to do or not remains to be seen. Feel free to jump in, Marianne or Jake, whilst I'm reading the other questions. Oh, a question from Andrew. What's your sense of whether the FCA or PRA will create more prescriptive definitions in the instant reporting space as banks' responses to TSC's request for information on items, etc., highlight a wide divergence in reporting instant numbers? What do you think are the pros and cons of prescription versus subjectivity? I think that's a really interesting one. And I think obviously on the back of the most recent outage, there is a greater focus on disruption and what firms are doing. I suspect it will be more difficult to add prescriptive definitions again. I think particularly with the focus on deregulation, I think the firms will, I think the regulators are best to deliver something that works for the firm and the environment of how they sort of operate. And I think it would be really difficult to prescribe what those should be. So I can't see it, but interested to see what your sense is if you want to jump back on that one. Oh, thanks, Gavin. Glad you found it helpful. Is there any other questions coming through? If not, we can wrap up. Just to say, unless any other questions come through, I'll start doing our outro. But this, as usual, has been recorded, and we will be distributing the recording and the slides so that you can distribute them to any colleagues who couldn't make it today. Otherwise, our contact details are at the end of the slide, so feel free to get in touch at any time. As I said, there's lots going on at the moment, and we are always keeping on top of latest developments. So if something's come up and you're just not sure, or you want another view or an opinion, feel free to get in touch with us, because we like to chat about all of these different types of topics. Anyway, you've got 6 minutes left in your diary, which means you've got time to go and grab coffee before your 11 o'clock meeting, which I'm sure is already in your diary. But have a great day, and we will see you at the next one. Bye-bye.